A very good morning to all of you. At the recently held annual general meeting, the members were present and they have elected Mr. Ravindranath as the new president of Bangalore Valuers Association. And the new committee members also have been elected as specified in the notice. I recognize the presence of the committee members, Mr. Neeraj Agarwal, Mr. Ravichandran.
Maithili, Senthil.
Yes, thank you. I welcome the new committee members. I hand over the baton officially to the new committee members. I am also one committee member in IT. Over to you, over to the new president, Mr. Ravindranath.
Thank you, Shilpa. Good morning, everybody. It will be my pleasure to be the presiding officer for the next term. We are going to continue with the same structure, same enthusiasm, and the same capacity building measures which have been initiated by Bangalore Valuers Association. At the same time, we will also be having more of workshops. That's what we have decided in the committee meeting. We'll be working more on physical sessions also with short sessions to build the capacity of members. And we also realized we have got patrons across India. So we'll be doing this activity across India, to starting off with Chennai, then Kolkata, then Pune, and also in Coimbatore. We'll be telling you more about this, and we'll also share a vision statement which will include all these things. So today is our first term, and we're all excited to hear to Ganesh Remani sir. So without much ado, I think we'll start him. And he's also today quite busy. Inside of his quite busy schedule, he has agreed to take up this session for us. Vijaya, you can just give the session to the person who's going to introduce Ganesh Remani sir. Thank you.
Yes, sir. Neeraj sir?
Yeah. Hello, everyone. Good morning.
Good morning.
Hope you all are having a wonderful Saturday early morning start. And I think after this session, I think your day will brighten up. Today, I have the wonderful opportunity of introducing Mr. Ganesh Remani. Mr. Remani is a practicing advocate enrolled with the Bar Council of Maharashtra and Goa. He has over 2.5 decades of experience spread over from entrepreneurship to become a part of driving business turnarounds and incubation of new businesses in diverse sector of finance, technology, retail, and real estate business. He's also the founder of Messrs. United N Consultants that specializes in evaluation of new business opportunities, incubation of new merger, business and acquisitions, and business turnarounds. He's also the founder of health and fitness startup Scale Fit. I personally had the opportunity of listening to Mr. Remani in a couple of sessions. I can totally tell you that this session will going to be very educative for all of you, because whatever sir says is the truth in valuation. So before we start, I have one question. How do you manage all those things, all these things?
So nice of you. Thank you, Neeraj. Thank you so much for your kind words. Congratulations, Ravi sir. I think for taking up the role to lead BBA, and I wish you all the best. And
thank you.
Thanks a lot, Shilpa, for conducting this session for previous term excellently. And I think now also it's in the safe hands. It has come from the safe hands. It has gone to safe hands. Yes, sir. I'm also a BBA member, and I got this opportunity, and I'm happy that in the new term again I'm the first speaker. Well, it's going to be a short session. Before I start, I think this session is more interactive. It will be explorative, and a lot of to and fro will happen. This is not some 30 slider, 40 slider presentation, but thinking so that when we go back to the drawing board every time when we are doing valuation, the questions that we keep asking to ourselves, are we confident about the value that we got? I'm not talking about the method. We are assuming that income approach, we are going to use it. That's okay with us. The question that we are supposed to ask is, whatever value we give, I keep seeing this question that comes to us, what should be the discount rate? What should be the beta? What should be the debt to equity? And the most importantly, how will I count the terminal value? What should be the terminal growth rate? So these are the questions that keep coming to us. And we are professionals, we are experts. So imagine if we are having these questions, people who are seeking a value answers, what is their plight? Second thing is, the more uncertain in our confidence, or the more uncertainty we have in our numbers, the lesser is the confidence that the client would have. What does client ask? I need this value. I think that's the starting point which all of us agree. And when he says a particular value, and if we are each one of us know that it's like an art, we cannot definitely say whatever value we gave as a number is a written on stone, and it cannot be different. But the principle is, what is it that we have taken, and what is the foundation of those assumptions that we have taken will determine the entire valuation. Unlike a relative multiples approach, that's relatively easy and better placed because you have a thumb rule there. There is a comparison in the market, there's a value. You can always differentiate whether we are matching exactly, not matching exactly. I understand that, but still we have a reference point. For income approach, what reference we have actually? So indirectly, what we all do is we do an income approach and we validate with any market PE to figure out, is there a reference? If not, we only hope and anticipate that client does not object and the deal takes place if it's a merger and acquisition deal at that price, and we are happy that no one has questioned us. Whether it's a statutory authority, recently in a simple 11-year case also, I saw where the officer was questioning the assumptions on the basis of why you have taken what you have taken. So I thought, let us actually delve into this income approach and understand, when we get financials from anyone, how do we go about looking at it? So I have a right to share the screen, right? Shilpa? I think so. Yeah. Okay. Just project it. And kindly do ask the questions, and we don't miss the thought process. What are the elements that we have? I just put a few elements. One, what are we given? We are given past financials. Second, we are given financial projections. Now, this is also a problem. Just now, Shilpa said someone is questioning why financial projections. Now, that's a different story. I'll come to that as well today. What should be the capital structure and the cost of capital? These are the four. Any other elements that someone in their mind that comes into picture? This is what they give. They typically give 3 sheets in Excel, or past financials and projections, past 3-4 years, 2 years. Then they give balance sheet and P&L in 2 sheets. Third sheet is your projections, and then they say that give me the valuation. Right? Anyone else has anything else? Do they get any other information? So we get this, right? Now, the first question that comes to our mind is, how many years back we should go for the past financials, right? How do we decide that? The question that we need to ask is, what kind of projections they have given, and is it in line with the past financials? That is the rationale behind it. So it's not about how many years we have to get it. It's about how much we are supposed to seek validation of the projections looking at the past. Now you might say that why projections can be different, past performance need not reflect future performance. Fair point. And that's something we'll be recording then. The importance is, when we say how confident are you in the valuation, we have to say that these numbers are in alignment with the past performance. Therefore, there's a proven track record. Therefore, we believe it will perfect. That's one answer. Suppose if we say the past performance is not going to be reflective, then we will say the past numbers do not reflect future performance. And hence, this is the rationale why we believe the future performance. We have to have one of these answers. We cannot have saying that without discuss. So when we look at whichever data which we ask, we need to ask these questions, why we are asking these questions. It is not for the namesake that we are asking 2 years data, 3 years data we require. Now, when we get the past data, what all we are supposed to look at it? We are supposed to look at it, how has been the growth in the company, in the revenue. So when we look at the growth in the revenue, that gives an indication, one, about the market that they are able to capture, B, the company's ability to grow, the company's internal processes, systems in place, how they are capturing, and C is, are they stable? Are they at a high growth? If it is a high growth, why it is a high growth? It is extremely important for us to understand and look at past data from that angle. Past data, someone said just now, should first forget financial projections, first look at past data and determine what is it that you are getting the story around it. You have to have a story on revenue, you have to story on revenue on cost, you have to have a story on the capital structure, and you have to story on the ability to raise capital, you have to have a story on the manpower and the capacity that they have. And once we have this, that is something we have to record it. It doesn't take time. Don't think that again this will take some 4 months, 1 month, 4 weeks, 6 weeks for valuation. Because if you don't do this, I'm not saying you should do it. If you don't do this, if someone asks you, are you confident on valuation, then what will be your answer then? The most common answer that we give is, we relied on the representation of the management on the past financials and the projections to arrive at our valuation. Is that not what we all take? Management representation? We take, right? We rely on the management. If we are supposed to rely on the management only and the financials that the management has given, then why do they need us? To put a formula? To put a formula and put a value, a number, and say this is a valuation? Can't they do it? So the value add that we are supposed to bring in is, we have the validation power. We have to do those right questions to look at it. Once we analyze the past financials, then it comes to the financial projections. They would have given various projections. I would run through that element. Then the next aspect that we have is the annoying factors. Terminal growth rate. Most of us accept that this is the annoying factor, how much we are supposed to take. Someone says we are supposed to take the GDP growth rate. Someone says, how can I take a GDP growth rate? GDP growth rate will be small. There's a many more years that the company is going to grow at a high growth rate. How can I take this? Therefore, I'll do a two-stage model, three-stage model. Someone would say, what should be my capitalization rate or cost of equity in the terminal side? And once, when do I take the terminal growth rate? How long I should take the projections? Should I take a projections for 5 years? Should I take the projections for 7 years? Should I take the projections for 3 years? For us to then work on the terminal growth rate. These are your annoying factors. Now, there is no right here. What is important is, once we understand what goes behind these data points, then you know how long you want to take. And if you don't get it, what to do? Because it determines your riskiness of your cash flows. So again, I think when I look at this, I always say that, what is the management's ability to project financials? How long? If the management says the industry is completely changing, I have no control in the ability to project beyond 2 years, then you only have 2-year projections. You don't even have 5-year projections. The question that you will then ask is whether you want to use income approach or some other approach. That's a different story. But for an ideal income approach, the premise of the income approach is, there is a stability in the cash flows. There's a tendency towards stability in the cash flows after the end of the tenure. If it is not having that stability, then the question that would come in is, can you apply the constant terminal growth rate formula? See, the constant terminal growth rate is emanating from an underlying theory behind it. You cannot say that I'll just apply, I grow at say 30%, 40% for 5 years and suddenly say I'll grow at 5% thereafter. It's not that it's not possible, but the question is that you will have to explain saying that when I'm growing at a 40% growth rate, I would have built such a huge capacities underlying my in the company. So suddenly when I'm from 40%, I'm jumping to 5%. That means either at the end of the tenure, I have completely exhausted my capacity that I cannot grow beyond 5%, or B, in all the projected years, I'll be actually be working at the underutilization of capacity. Is that okay? Am I right? Are you following me? That's just to reconfirm myself. So when you are looking at terminal growth rate, the tenor, the question that you are supposed to ask is on the how it is abruptly. It's like movie ending abruptly without knowing what to do. So projected financials is also like a movie story. You need to look at and feel how the organization eventually look at it. What is the tendency of the organization? Now, these are not complex. So when you actually doing a valuation approach, once you ask this question, you have an answer for it. Once you have an answer for it, then you're moving it. That answer you have taken, you are not an auditor to validate the answers. Whatever basic information you have it, from there you validate it and you go ahead with that. And that is something is recorded in your report, why you are considering what you are considering. And based on this particular terminal growth rate planning is where one will determine the riskiness of the cash flows, which is nothing but the capitalization rate. The riskiness of the cash flows is an essential ingredient for someone to evaluate. It's not about what should be the discount rate. I have taken 12%, 7%, 5%. I mean, that is not the basis. You need to determine how risky are the cash flows in the numerator according to you. How will you know according to you? You would have just evaluated that. Based on that, you are actually making a statement. Because if today all of us are finance people, when we go and do a secured lending, we get a different rate. When we go for an unsecured borrowing, we get a different rate. We accept that, right? For unsecured, if self-employed person goes and seeks loan, he's charged even more. When banks are able to differentiate between the category of the people, the presumption is the riskiness of the potential recoverability of the value along with the charges is what they are measuring it. Simply, it's called a credit assessment. So we are actually doing the cash flows that we are talking in the numerator is essentially we are determining the credit assessment of those cash flows, whether it's like a credit assessment. We are assessing the cash flows. Based on that, you need to get discount rate. When I have done even after terminal growth rate, when I was not confident about the cash flows, I have done different capitalization rates for different years. I said, this is what I'm going to consider. That's my choice because of my assessment on how the rate should be. So standard techniques, I'm not here to explain the techniques here because all of you are experts in this, free cash flow to the firm, free cash flow to equity. I'm sure we don't need to discuss the techniques associated. The reason I said I put up here is in the numerator, we get cash flows. The denominator, we have the discount rate. Honestly speaking, in all the communications that I also receive in the groups, how much time we ask or spend on the numerator, how much time is spent on the denominator. Numerator, we hardly ask questions, whether the growth rate, not growth rate, cash flows. What we ask is, what is beta? What is cost of equity? What is terminal growth rate? And market return, how do we calculate market return? Whether we should use CAPM model, how do we do size risk premium? Because we are all fixated that those numbers are not available from the management. Those numbers are to be coming from us. That's why we are concerned. Numerator management is giving it. We are saying that we are relying on the management. So we are very happy with that. Denominator management is not giving. Denominator, we are taking it. That's why we are all worried. And we start asking denominator, what should we take? The question is, we need to spend significantly more time on the numerator because denominator is a function of the numerator. The more we have clarity on the numerator, I'm assuming numerator is cash flows, denominator is cost of capital, right? So the more we are confident. So fundamentally, when someone asks this, whether what do I want to focus on? I'm focusing on numerator. Please explain to me how will cash flows come. The more confident we are, whatever numbers we take in the denominator, no one can challenge us. And that is essential. So in other words, what we are doing is we are trying to do the credit rating. Are the numerator cash flows are AAA rated cash flows, AA rated cash flows, and BB rated. We are actually trying to do an assessment on the cash flows. Once we have that, we are good to go. Then your denominator will come automatically. You don't need to take even beta and all. You can just take a discount rate. Absolutely fine. The cost of equity is nothing but the market cost. I'll also discuss this sometime down the line. So yes, numerator versus denominator. Let's focus on the numerator. Are we all in agreement, or anyone wants to disagree with this?
So we can focus on numerator, but what happens, we are getting work from maybe startups which are only 1 year, 2 years. We don't have much of a revenue in the first 2 years. So how will compare the revenue and the projections? And then they are not building any assets. So they are just improving the turnover, and they generally we are not getting any peer so that we can compare what is the standard industry growth rate for these projections.
Correct.
So that is why one of the reasons to just, I can say that blindly follow the management projection is that because we don't have much of an options here.
Excellent, Neeraj. I think so. Let me put this a little differently. Do you know this regular bank debt that you get? How much you get it at secured debt? Around 8%, 10%, 10%, right? Agree?
Yeah.
Then bank said they will also do unsecured lending and they have increased the rate little bit. Agree? Do you all agree?
Yes.
Then we said ki there is something called as a mezzanine financing, and they came with some kind of instruments. They increased the rate and they said ki this is the rate now we'll apply and we'll also give the loans.
Yes.
And now we have something called a venture debt. You are aware of this, right? Venture debt capitals have come. So instead of equity, we are giving us debt, but all of them are unsecured, right? With the riskiness of the cash flows, right?
Yeah.
So now what we are essentially saying is each of these instruments that have come up have not come up on a standalone basis. They looked at the riskiness of the cash flows and therefore determined what should be my discount rate. So what is venture debt or what is mezzanine financing? The lender is saying that there is some uncertainty of the cash flows. I am taking the risk. If this is the risk I'm taking, what should be the return I should expect? So we have a benchmark on that. So if someone is giving you highly unsecured startup kind of a cash flows, someone who is providing debt, we already have a reference what is the cost of venture debt. Agreed? So assume it is 20%. Now, how on earth we can say it will be 35% or 18%? At the most, it will be 20 to 24 in and around that percentage only. Do we really have a magic wand? Because the denominator is a function of the expected cost by the lenders or the funders of the capital, right? So that is really a stability there because someone is determining if this is the kind of a risk, this is the kind of risk. Now, whether that cost is good enough or not, there are market expectations. Market has been created around what should you expect on the cost of capital for such kind of a cash flows. It is important for us to know. 1 second. Ask him to get the car. So what is important for us to understand is, it's if a startup has given 2 years projections for you, first you need to take a call whether you want to use the income approach. This topic is not on that. That's a different topic. We can always have a discussion. Suppose if you're saying that you have to use income approach only, I take you as Neeraj as an example. Then 2 years, how do you assume you're ready to take the discount rate also? Then what is the terminal growth rate? Income approach means my cash flows are going to come till perpetuity. That's the philosophy of income approach, right? Unless you say that I only get cash flows for the next 3 years. After 3 years, I will sell to the market. If you're selling to the market, someone is buying after 3 years. What is the basis of that guy's buyer? He is expecting that because I am going to get cash flows till perpetuity. That's the philosophy under the income approach. It's a going concern approach. So when a startup is giving, what we are saying is, hey, this is a 2 years cash flow, they said. And based on this 2 years cash flow, this is the terminal cash flow that they are predicting. So we have 3 cash flows. One is the terminal cash flow and the projected cash flows for 2 years or 3 years. Then the question that you need to come in is, if you are how much confident, how much past alignment is there vis-a-vis the current projected financials with the past financials. If it is not aligned, it's an extreme high growth rate, then the question is, what kind of a riskiness is there in those cash flows? What is the rating that you would like to give? And if you feel that this is a high risk category, so you have a benchmark. If it's a very high risk category, you will charge 40% discount rate. If it's a high risk category, and then you say this is the reason for it. You can do a focus. I mean, if you're so serious and if you really want to be even more better than the understanding, you can actually reach out and talk to a wide high net worth individuals who typically lend in such complex situations and get a focus group and get say, this is a research that I did, this is the cost of capital expected return, and therefore I'm looking at this range. Absolutely fine with that. But the basis is very important, right? But how would you ask? Suppose if you go, if I come to you, Neeraj, and say that, boss, what will you charge me? First question you will ask me is, what is the business where you want to invest in? I said that here is it. I'm interested in the business of, say, health and fitness. Since I started that, okay, health and fitness startup. Then you'll say, okay, what is this business? I say it's a service industry. So do you have any assets? I say no. Then you'll say, if you don't have any asset, how do you expect it to grow? Then I will say that, boss, there's an expectation, market is very health conscious, it's going to grow, and all that English, I'll give it to you. Then what is happening here? You are trying to assess my project, my ability to generate those cash flows. So you are doing a credit assessment. You are doing an assessment of my cash flows. And then you will say, Ganesh, your cash flows for me is difficult. One, I'm not at all confident, so I will not fund. B, I'm partly confident, but since it's very risky, I'll charge you this rate. So and then say, Ravi will come. Ravi will come with other CA firm projections and all that stuff he'll give. Then what will you do? He has been doing this CA firm. He has this projection. His projections looks tapered like this. You may charge different rate. Both of us have come to you, but you have charged different rates. What is the basis of charging the different rates? The basis is the numerator, which is nothing but the riskiness of the cash flows. You can never be confident on your denominator if you have no fundamental understanding of the numerator. And understanding of the numerator doesn't mean that if they don't give answers, I don't have it. That itself is an understanding. Suppose the management says, I don't have anything to prove, but I want to get this. That's also an understanding. Then essentially you're saying that this is an absolutely speculative ability. I'm absolutely going on the sheer words of the management. That's okay. That's a one way to look at it. And that's an assessment. Your assessment is your belief that the management will get these financials based on the management's capability because there's no past track record. Now, how much is the cost of capital? For that also you have a different kind of a cost of capital.
Sir, I have one doubt.
Yes, sir. Please, sir.
You mean to say is based on last 3 years performance, the projections are too much of aggressive. We need to increase company specific risk premium. Is that the point to be taken, sir?
Yeah, you're absolutely right. I don't use the word company specific risk premium and all. You're right. That's actually the indirect meaning. I always look at the total capital contribution. Whatever is the capital that we are contributing for the requirement of the company to grow in future, what would be my cost given the stage of the company, given the stage of the cash flows? So for example, your mission, you said company risk premium, you take say 3%. Now, the company now which has given 3% is a risk premium is a good because you have assumed that that's a number and you have done a 5 year, next 5 years. But after 5 years, company would have grown at a particular size. Will it be same risky? The riskiness remains the same that time also? Wouldn't the risk premium come down?
Yes, sir.
So
come down, sir.
Therefore, our answering is again, which cash flow, and given that cash flow, what is my risk? That's why I also said even in a 5-year financial projections, if I had to take a different cost of capital, I take different cost of capital. I write the answer, reason for it. I am taking it because, for example, let me take this example. Someone is in the business of getting some licensing for next, and it will take 4 or 5 years. Let's take toll project, classic infrastructure. For toll project, for 4 or 5 years, initially there will not be many cars. There's other infrastructure surrounding that it has to be developed and all that stuff. The first couple of years projections are difficult to be sustainable, correct? Because unless the infrastructure comes in there, you may not get many vehicles in the toll and your cash flows may not be there. Agree? But after 5 years, when infrastructure comes in your model, then it's an automatic way. Everyone is going to use the toll. Your cash flow certainty is higher. Therefore, the cost of capital that you're going to consider after 5 years, how can it be the same as cost of capital for the first 5 years? Both are cash flows, right? You're discounting numerator. So the tendency for us to use one rate is a challenge for me, because we are not looking at it, this new denominator is because of the numerator. Numerator nahi hai to denominator nahi hai. The more we emphasize on numerator, the better we have control, at least confident. I'm not saying we are absolutely right on number. We are confident on the denominator. And that is the reason why I always say that, imagine once we do all the valuations, when we are all put in a conference table, round table, and each one of us asks, how confident are you on valuation? Without saying that we are relying on the management's representation of data. That becomes a challenge.
I want to extend this logic. Say, for example, in a 5-year projection as well, in case first and second year, the company has not even projected any turnover, it's a pre-revenue, then the first 2 years cost of equity, what we have to consider should also be less, no?
Cost of equity less or more?
No projection of revenue is there for
No
the first
cost.
2 years.
No cost. You can give a different one. So there are no cash flows. You are discounting the cash flows. You're saying only thing is, suppose you have okay, you are only borrowing there because there's no revenue side. It's okay.
We are binding up the R&D. It's an aerospace.
It's a pre-operative expenses.
The satellite launching and all, they need some time to, it's a pre-revenue. So 2 years, no revenue projected. There also the cost of equity should be less, but third year it can be more.
Whether you take cost of equity less or more, the value is zero, right?
Third year, it will be different, applying the discounting.
Correct. Third year is different.
No cash.
What you take in the first 2 years, if the numerator is zero, whatever you take in the denominator has no meaning, right?
Third year, it has an impact.
Okay.
Yes.
That's why I said the cost of equity is not a function of the previous year's cost of equity. Cost of equity is a function of the numerator.
Okay, got it.
The problem is when a company has multiple revenue streams, like they are into AI, they are into software, they are into this one. So we are unable to predict the numerator, and those times we go by the management of this thing, because we do not have a data that what will be such a mixed company, what will be the revenue growth again. This is problem one. Problem two is that terminal growth rate, by default everyone is taking that below the GDP growth rate.
See, the answer is this. So, whenever you have multiple segments, you have to do a segmental analysis. That I'm reasonably certain. So each segment you have to look at it, because see, it's not about we to give a number. Again, I'm telling you, if it's a formula, we have to put a number and put it, that anyone can do it. Then the question comes in is, why does potentially some of the clients, not all the clients, undervalue the valuers? I mean, they don't value the professionals, because they say that you are taking my data, you are putting in a formula, you are saying that I have given this data, you are not taking an accountability, and you are asking me fees. Then they say, give me what I want. And then we give a thing with a disclaimer. Now, I'm not saying wrong. I also do. We all do it. Now, question is, we need to go back and say that, hey, you are giving all these things. We'll ask these questions. If you don't give answers, we will put all the disclaimers. So then he cannot say that why we are putting disclaimers. Number one. Second thing is, if he gives all these projections, we question this. And if he says, okay, I'm changing it, That means he says that these guys know, so they start respecting us. So this is in our own good interest. We ask all these questions. And we'll be very see, we don't need to be worried about the exact number. That statutory requirement is there. What we need to be worried is when we give in, the other person should find it difficult to question us, especially any person, whether the client, other professionals, or regulatory authorities should find difficult because we have done justice to our approach. So,
sir, two doubts I have.
yes, sir.
Okay. Two things. First thing is that you give the example of toll road. Toll road is a definite period, no finite period. It's not infinite. Normally it will be for 20 years, 15 years, 30 years.
Yeah.
So should we take a 30 years projection and then discount it, or can we take that growth rate model? Question number one. Second question is that in many startups that we are getting, the projections will be achieved only if we get this fresh equity. So I'm getting into a problem of pre-equity, post-equity. So how do you handle that? Because without the additional infusion, projections can't be achieved. And that's it. These situations, how do you do in those cases? Two questions.
Excellent, sir. Good question. Two quick ones, and then I would need this just less than 5-minute break. I'll have to get into the car and again log in, and you all can stay here. But I'll answer this question to you.
Yeah, we have some announcements to make. Yeah.
The first question that you referred to is regarding toll rate. If there is only 20 years or 30 years, then should you use the terminal growth rate? It's a clear cut answer is there. If it is for 20 years, there's an agreement associated with 20 years. And if you're doing a project specific valuation, you have to look at that legal agreement and project for 20 years. There's no second thoughts on it. It is not a terminal growth rate. But principally, if you're trying to take any other method, you need to look at whenever you use a terminal growth rate, use it. So use a terminal growth rate and identify how much is the value beyond 20 years is being accounted in the terminal value if you are using a terminal growth rate. That is simple. You just take the projection, do it till 20 years, beyond 20 years, again do the same terminal growth rate, and then do the present value and identify what is the percentage of the value that you are actually being assigning to the numbers beyond 20 years, and you got a number. And depending upon the case specific, you can take a call. Because if I'm in a toll road, I am saying that 20 years I'm going to get this, and I'm valuing the company will have another business model. Then so you make those statements saying that it's a going concern company's inability. If you're doing a project specific, like a real estate project has 1 crore of FSI and you need to develop only 1 crore of FSI, you're valuing the project and the company has only one project in that. Then it has to be a specific tenor, not a perpetual. That's one. Regarding the pre and post, I didn't understand that question, but what I will do is I'll get into the car and I'll pick that call, take that question again. Give me a couple of minutes. With your permission, I'm logging out and I'll log in again. Okay.
Yes.
Thank you. Bye.
Once again, a good morning to all the participants of today's session. Around 9 o'clock, we have scheduled a demo session from a database private circle. Okay, Mr. Krishna is the founder, member, and director for this private circle database. So around 9 o'clock, we will be having a demo session from him. We have been receiving requests from many members that, the private companies' data, it's becoming very difficult to access from various softwares. We do not have it readily available. While we have all the listed company information readily available, we do not have so much information about the private companies. That is why we want to explore this private circle database. And then we have, as you all know, the database softwares and all the subscription fees is extremely high. Even this company, it was very high. But then we have requested them to give certain, a relaxed fees for us. So we have made it the pricing and all. The promoter himself will be sharing it. It is priced very nominal. Rather, I can say much less than the existing softwares in the market. So I can say a specialized rate for considering registered valuer as an user. Okay. So I request all of you to stay even after the session. 9 o'clock is the expected time for this Mr. Ganesh Remani session. Between 9 to 9:30 is what we have planned. So any doubts you have with respect to any database using of a software, if at all you are interested, you can either directly approach them, or we can have another separate session in case you want a detailed demo. Half an hour is too less a time to actually decide whether to subscribe or not for any software. But then, yeah, this is just an initial piece, just they'll showcase about their software. Whereas the highly priced version has got an unlimited access to the database. But the one which, as a valuer, which we could be nominally charged, has got slightly limited access. But then, the founder will be explaining much more in detail about the software. Anyone else has any doubts, you can raise about the demo, not about today's session. No doubts? Okay, no problem. Mr. Ravindra, would you like to share anything about the new programs, what we are planning? Any dates you want to, indicative date you want to share with the members?
Shilpa,
yeah,
before, okay, go ahead, sir.
No, you can continue. It's okay.
No, so please make this announcement. I had some technical question to be asked. Ravindra, please go ahead and make the announcements. I have some other technical questions which I thought I'll discuss within the group.
Okay,
Please,
so
Mr.
we have
Remani.
Shilpa, you can hear me?
It's breaking.
Yes,
I
sir.
suggest if you can switch off the video because your voice is cracking.
Okay, how about now?
It's very clear.
Yes.
Yeah, actually, I wanted to tell all the members present here that we have chosen a couple of dates to conduct physical sessions. November 16th, we are planning to have an event in Chennai. It's a full day event, which will have two technical sessions and two panel discussions. So I request members to give your ideas on what kind of technical sessions you'd like to listen to, and also what kind of what would be the panel topics you would like to listen to. And also, if you have any good speakers in this part of the region or any region who will be willing to come to Chennai, it will be much appreciated. This Chennai event will be led actually by Vishesh Unni sir and Ravi Chandran sir. So you can actually be in touch with them for that. And I also request you to block that date for November 16th. I think it's the third Saturday of November. Then we have another residential program which is coming up near Ooty, Coimbatore region. It will be a 2-day residential workshop. Focus will be on a case study based theme to help us to build our capacity. So case study will be released much in advance. We'll be working on that. And when we meet there, we'll have a lot of brainstorming and build on that case study. That's how it's going to be. Again, for that also, we are looking at good resource people and a good topic. If you have in mind, you can share those things with us. And the last is...
Would you like to share the indicative date for the OT program, Coimbatore?
This date has been freezed. This date is on February 14th and 15th. It's a Friday and Saturday. And Sunday is off. Saturday we'll be leaving early by 4 o'clock or 4:30. Just to accommodate people who want to travel around to Ooty or even in Coimbatore, a lot of temples, Isha Foundation and things like that. This will be led by our Coimbatore patron, Mr. Abhishek Arvindam. I don't know whether he's there in this session. So we'll share his details also with you. So you can either share the details with us or with him. And I request you to kindly block these dates, February 14th and 15th. It's a Friday and Saturday.
That will be a 2-day residential program.
2-day residential program. Again, all our programs are very economical, normally priced and high value. So I request you to kindly make yourself free. And if nothing is scheduled on those days, I request you to schedule these dates. And another program is getting scheduled on most probably April 26th or May 2nd or 3rd. Date will be announced to you. It will be held in Kolkata. Again, it will be a 1-day event wherein we'll have 2 technical sessions and 2 panel discussions. We'll announce the dates, and Neeraj Agarwal, again, who introduced our speaker today, Ganesh, will be spearheading that. So I again request you to schedule those dates for us to meet in Kolkata. Yeah, back to you, Shilpa.
Yeah, request everyone to give their suggestion for topic speakers for all the programs which the new president, Mr. Ravindra, has announced. Over to you, Mr. Ganesh.
Yeah, thank you, everyone. What was the second question about the IPO? What is that question? Can I get the question again so that I can answer that?
Mr. Ravi Shankar, are you there?
Yes. See, the issue is that when we get these projections, they are based on additional equity. After if the equity comes, then only he can meet the projections. Otherwise, he can't.
Correct.
So in such a situation, how do I? Okay, because normally we are supposed to do before contribution is what we're supposed to do the valuation, whereas in this case we have to do the valuation after the.
So you are saying that the cash flow which you are pumping in, you have already accounted for. So how do you do the present value of that? Because from a value perspective. So, okay, I'll put this question other way around.
Right.
If I'm valuing this entity, financial projections, okay, whether I'll be considering the debt component for future? Yes or no? If I have to borrow in future.
Yes, that's my question. That's my question, sir. Right.
That's what I said. So today I'm making a financial projections. I have to make borrowings, right? Bank borrowings. Am I considering those as part of my acceptable cash flows?
Yes.
Net borrowings, right?
Yes.
In the form. Do you do net equity or net borrowings in the free cash flow to the firm?
That you should tell us. That you should tell us. Now, ask me.
The answer is this. If you are actually discounting, how you get money is something I'm not bothered, equity or debt. For me, what matters is what is the amount of money that I'm borrowing at that point of time, whether it is equity or whether it is debt. The change in the debt or equity is only impacting the amount at which I'm going to raise the capital, finance the cost. So when you look at this wordings, net borrowings in the free cash flow to the firm, that is looking at the total cost employed because there's an impact on the interest rate potential and there's a discounting cost of capital. If my borrowings is completely in the form of equity, so be it. That gets adjusted and my cost of capital I'm doing at the cost of equity below. That takes care of that. That is the way I would look at for the future projections. In other words, I'll ask you another question since you said the retained earnings are in the company. Are you not reinvesting? Yes, right? If you're reinvesting, retained earnings is nothing but your equity that you're pumping in for future projections, right? So the belief that just because we are raising equity from external sources, we should not consider is something not probably doesn't appear to be correct. Does that help? Yeah, Mathili.
I have an add-on to that. So this is one perennial problem. We have it in all cash flows. This is like a chicken and egg story that we have. The two most in the case of startups where they have a hockey stick growth, unless you infuse funds, that doesn't happen. And they want it for that future projection, which is a hockey stick growth. Now, I have seen two approaches that happen in this process. Well, if the person is actually not infusing money, then you would actually try to go and take a personal debt and fund the expansion if you feel so passionate about the project. That is one. So sometimes what we take an approach is that we infuse the same as debt and we take a higher percentage of debt because it will not be either personal collateral funding or it will be based on without collateral. So depending on that, we take that and we infuse it as debt and we take a whack on that. Now, there is one more thought process where I have seen certain cases where they infuse equity to fund that expansion and then subsequently they take a present value of that infusion and reduce it in order to take the pre-money valuation. So approach wise, I find both of it sort of okay, justifiable because I'm still, for whatever money that I'm infusing in equity and funding that expansion, I'm reducing it to the present value, which feels justified. But what is that take on it? I know retained earnings gets reinvested, but first of all, to get that growth itself, you need infusion. Otherwise, that growth doesn't happen.
See, the question is as follows. If additional capital that you are going to raise money, either as equity or by debt, okay, if that is going to generate me the value, that means if you see in my PPT also, I use the word availability of capital. Then you are supposed to look at the ability to raise capital as a principle to determine whether it is possible or not possible. And if it is possible, it's very much part of the normal process. And I don't see a different way of treating that because for me, whether it is a borrowing debt, whether it's a equity debt, doesn't matter. Now the question is, the one who is going to fund this capital today, he is valuing it, and tomorrow after 2 years, he himself would be actually putting in that additional capital. But since you're discounting at a cost of equity, you're taking care of it. Whatever capital you're putting in money, you're actually getting the expected return from that capital by the discounting at cost of capital. What you are supposed to see is key, whether that capital ability to raise at that point of time, is it possible or not possible? And if it is possible, then the riskiness of cash flows is according to that. And if it is not possible, then according to the riskiness of the capital varies.
So when we do the projections, are we supposed to show it as infusion of equity and then discount that as well to get a pre-money, or shall we ignore that infusion itself and then take only the free cash flows and discount it at cost of equity?
I take it as a pre-cash flow. I don't even adjust typically the cash flow that are being pumped in during the times in the projections.
Okay, you don't consider that line at all.
That's right. Because for me, if I'm doing a free cash flow to the firm, I'm at the firm level, and the entire capital I'm discounting it. So what is the value I'm putting in? Because as I said to you, whether it is a retained earnings, whether it is external borrowing, I look at whether I am in a position to do that or not with the capital that I look at it. That is one way. The other method is essentially that you will have a negative cash, because if you are if you're not having a source of capital, your free cash flows will be negative then, right?
Correct.
And you will have a positive cash flows and negative cash flows all around the place. Then you are not in a position to do the IRRs of it. See,
so in that case, we will have to actually infuse in order to have a cash flow even to discount.
The presumption is, again, I'm repeating to you. Okay, I'll just give an example to you. In this scenario, you have assumed that there is an extra requirement of 200 crores of equity. Hypothetically, I'm just putting a number, right? And therefore, you are worried, what should you do? At this stage, you don't know. After 3 years, that entire 200 crores will be debt also, right? If it is debt, you don't have a problem.
Right, correct. That's true.
It's a financing cash flow. Just because someone says, okay, I will be going for fundraising as equity, you are having a problem. So it's in a mindset, right?
Correct.
So anyhow, it's a financing cash flow. If you see carefully, we are not looking at financing cash flow discounts. We are looking at the discounting the operational cash flows. The operational cash flows get impacted only from the impact. If I look at the equity level, cost of interest, if it's at the firm level, that also we have no problem. Financing cash flow should not be impacting the operational cash flows.
Yes, sir. Sir, I have one final question.
Yes, sir.
Remani, sir?
Yes, sir.
Sir, you are saying that we calculate the EBITDA or free cash flows, then discounting. In any case, when it comes to the financing, whether you go for a debt financing, you deduct the interest. At the end, again, we add back the net of tax. If you're going for equity. So you are saying that financing has no relevance, whether equity, borrowing, or if there is no borrowing, closing cash balance will be negative balance. So we should not be bothered about financing. We should just take free cash flows and discount it. Is that my understanding correct, sir?
See, financing is not that you're not bothering. Financing, what you're showing is the cost of finance you're changing.
No, sir, what I'm saying is financing, it will not impact my what is called.
Let me ask this question to you. I think, and we'll put it. You have a revenue, you have a cost, everything is there, and we are doing at the firm level. So we are not looking at we are looking at EBITDA level. Okay. And that cash flows that you got it because you have raised equity or you have raised debt. One of the reasons you got those cash flows.
No, sir. No. What I'm saying is business is different, financing different. So assume that I have no business.
the project have 1,000 crores of turnover, 100 crores of EBITDA. That to make 1,000 crores, I may borrow or I may go for equity. If I'm borrowing, then I'll go deduct interest. At the end, again, I'll add back the net of tax. So it has no impact. If I'm borrowing equity, then it is investing. So what I am saying is free cash flows is independent of my financing. Financing, even assuming that when in the same case, if I don't borrow, my closing cash balance will be negative. But again, the after is that the logic works out, sir? Hello.
Okay, I'm listening. I'm listening. When
No,
we
what
are,
I'm saying is, yes, sir.
so one second, one second. So I'll just try to paraphrase what you said so that I'm in a position to answer that. Okay. There is a free cash flow that you got in operations, right?
Yes, sir.
EBITDA
Yes, sir.
level. Once you get the operations of EBITDA level, you got there are two components on it. My ability to get those projections are a function of my ability to raise capital. Because someone says, Baitri said there's a jockey stick, and Mr. Ravi said I'm raising capital in between. So my numerator, whatever cash flows I got, is a function of the denominator what I got in, right? The denominator what I got in, I'm not even looking at tax now. It's the cost of capital where you apply the interest impact, tax impact, and all that stuff, depending on the capital structure that you take it. I'm looking at a number there. The cost of capital that I get in is my ability to raise capital to generate those numerator cash flows. So if I'm able to generate my numerator cash flows, whatever is the certainty is there, and corresponding to that, whatever is the cost is there, if I'm able to take those costs in the denominator, then I'm good to go. I don't need to be worried about any adjusting of any equity or something.
Okay.
Now,
got it, sir.
Now the only question I'm thinking now, remember one thing, whether it is a debt or whether it is an equity, it has to be repaid. The principal amount has to be repaid, right?
Yes, yes, sir.
Right. So now, whenever you are talking this perpetual cash flow, you don't talk about the principal repayment. You say that this is a constant debt to equity structure is there, which is going to be there for perpetuity. So to that extent, my numerator cash flow that I get it, when I'm doing a discount rate, my discount rate is limited to the interest or the financing cost, but not about the repayment of the absolute amount that I have borrowed either as equity or as debt. So that is the liability that is coming in the books of accounts during the projected period. When I'm doing the present value of that, and today's terms, if I am not subtracting that particular absolute value, then that liability we are underestimating in the valuation. I think Ravi Devarkonda sir, is this the question?
I agree with you, sir. That's true. So that is why sometimes we infuse it as debt in order because the repayment gets factored when you do an FCFE.
So repayment of principal amount is not captured in your the change in borrowings. If you're doing FCFE, the change in borrowings is what you consider. That is when you look at it. But you're not trying to repay that time also, right? You're not trying to repay at that point of time. You're doing only the interest cost.
That's why I asked whether we have to infuse it as equity itself and reduce that as well for the cost of equity. Because it would be a post money, should be reduced. Because I know that when I do a debt, it automatically gets reduced if it is I'm doing it as an SCFE. Automatically, the repayment gets tracked there as part of the cash flows. I will not have this scenario.
Change in market borrowings. You're referring to a change in market borrowings.
Yes, correct.
But the change in market borrowings, you can also put in the equity component. Na? Why are you not counting any borrowings? They have not defined borrowings as only debt. Why are you not considering it as equity component also? It's a capital borrowing, right?
Right, but sometimes you can't repay the capital, right? When we think that, okay, you're introducing a share capital, that should not reduce over a period. That is what is your mindset.
No. The logic is today when I am taking the company and I'm giving a value, okay, for me, any new shareholder, whether he's bringing in the money as shares or whether bringing money as debt, for me, it's an external cost. Na? Unless he says that he will remain there, I don't need to repay, company is going to keep it. If his company is going to keep it, he is a shareholder of the company. He gets so much rights in the company. So any kind of borrowing, you can adjust in the capital in the free cash flow to equity, then you're looking at it. In the change in market borrowings, you can put in the equity part of it. What I don't do is intermittent, whatever the cash flows got pumped in, I don't try to subtract here. I always say that today when I'm looking at it, whosoever is coming and buying at this today's point of time, today's liability is only so much for that person. All the future liabilities or future, whether it's the form of shares, share, someone has funded as equity, someone has funded as debt or other instruments, that needs to be repaid through that cash flow source.
No, but sir, anyway, we are taking the more number of shares, no?
Sorry, go ahead, sir. Ravi, sir. Yes, sir.
Consider only as a fresh equity. Okay, that means the number of shares are increasing, and at the end, we'll be dividing the value of the company firm by more number of shares. So that's how that doesn't take care of it.
No, you are looking at per share value. I am looking at absolute value of the company. I am not bothered per share of the value. Tomorrow I can split the shares. I can do per share value. I don't bother about per share. For me, what is the size of the value of the company is important.
Okay, got it.
So, sir, you're saying future repayment should not be considered in today's when you arrive at the equity value.
No, I am considering in the free cash flows itself, the borrowings part of it.
Okay.
If I do a free, see, please understand. See, again, I don't know whether I'm able to communicate. For me, today I'm valuing what is it I'm doing today. Given this current status, tomorrow, whatever projections are there, the projections, to achieve those projections, how I raise money, I have to pay that money. Now, it's hypothetically we are saying that equity I don't need to pay. That's a structure. I could have a debt guy who says that perpetually I'll give a debt. There could be an instrument on that also, right? The philosophy there is that whatever today I'm paying it, any new capital that is coming in, since I am the 100% shareholder today, for me it's an external liability. How I repay that liability? If it's a debt, I repay from the cash flows. If it is equity, I part my shareholding partly to that guy, and that's how I'm repaying to that guy. But eventually, today, when I'm valuing myself as 100% guy, for me, that's a liability. That's an external liability.
Okay.
Did that help?
Yes, sir. Yes, sir. Yes.
Okay. So I move. Ravi sir is fine. Maithili, you're fine now. Should we go or any more further thoughts on this? Should I?
It's fine, sir. Go ahead. Go ahead.
Thank you, sir. So now, again, look at this. So every word that is used in the formula, once we understand the principle behind that particular element, then we are in a comfortable situation how to interpret that and how to use it. So as I said to you, I am more worried about the numerator. So all the questions, when I get a simple one Excel sheet, I do ask, I mean, there can be many more. I've just given as a reference some of these items for people to visualize it. Price per unit. I look at when the projections, when the past performance has been given, I look at what is the inflation, what is the price change based on that inflation, the ability to increase the price, elasticity. Certain businesses, they cannot increase every year. They increases every 2 years. It's not easy for them to increase every year. The product positioning. Suppose someone is in a business where it's a direct transfer of the cost. Where for them it increases, they can increase to us. For some, it is not possible. So under where it is product is, whatever is the products they are servicing, services, we need to look at it. And then of course the competition. So I was recently doing one business evaluation where it was very clear. The revenue cannot increase unless I get new customers. If I have only existing customers, my revenue decreases because that business model is like that. It's very difficult unless it's some 3-4 years gap is there. So when we are projecting, we know that we are actually getting a new market share. The market has to grow, and that's the only way you can increase the revenue. So what is the market? What is the competition? So unless we understand price per unit, whether they can expand or not, we will not know whether the financial projections they can achieve. Because in the financial projections, in the revenue, there are two components. One is the revenue, one is the quantity, one is the price per unit. So we need to look at what is growing. If it is quantity which is growing, that means they are getting market share. If it is price which is growing, that means they are better off in the competition and market allows the price to grow. This split is needed for us to look at. Right? When we look at the revenue in absolute terms, they have given a year-on-year 20% growth rate. Past, they have grown at 20% growth rate. Therefore, it is possible to grow at 20% growth rate. That's a standard answer. The question is whether the capacity, for example, if it is a manufacturing product, then when they're growing at that particular rate, corresponding investments did they do on the capacity? How long it takes? So, for example, if we take cost as a percentage of the revenue, and certain manufacturing products, it takes 1 year, 1.5 years to establish a setup, there is a higher cost at that point of time before the revenue kicks in. Whether we have taken into consideration that aspect of it is an important element. If it is a 30-year, 20-year company projections, then the cash flows are already seasoned out for such kind of variation. But if it's a newer company, if they have one established manufacturing plant at one place, and if they're doing a second or third plant now, you would definitely have variation in the cash flows because of these investments. So investment side. And you need to ask how much is the capacity you're adding, and therefore you will have higher depreciation corresponding to the revenue because you will not achieve the same capacity utilization on day one when the revenue kicks in. So when we take as a cost per revenue of whether it's all the elements that we have here as a standard percentage is also a problem. We also say that we'll have economies of scale and we reduce the cost from 6% to 5%. I'm not saying from a costing perspective. I'm not saying it's wrong. I'm saying that once we know why it is 6%, and if the revenue is stable revenue, and if I'm saying that I'm going to get economies of scale, I understand that. But if the revenue is not stable, and if it is like the jockey stick or a varying revenue because of the new investments and new growth rates, then it can never be the standard 6%, 5%. Each element becomes important. Revenue could be from export obligations. So you need to look at, you need to have now you will say, if I have to do a valuation in 2 days time frame, how am I going to do this, some kind of export obligation? At least you ask those questions. Once you have those questions, you have an answer for it. Given that answer that you have it, you will have some framework, some understanding, and say that therefore I would like to put these numbers. If you don't ask those questions, for example, if you're doing a medical devices where there's I was doing one research on medical, I was doing valuation for one company. The corresponding competitor who is listed in the public domain, he has 70% exports. The one that I'm valuing has same turnover as that guy, but 70% domestic sales. Completely different. My regulations that the other person, I don't have a comparison. Exact comparison because the model is very different. So unless you ask that, and sometimes what happens is when you give these projections and drag for 20%, 40% growth rate, you need to look at what is the market share these guys are capturing. It is extremely impossible for someone to be a 50-60% market share leader unless and otherwise he is a dominant factor in terms of brand value. Because the moment is a market, and there's a moment there is a market is growing, and the moment there are possibility, you will have competitors coming in, and supply side there will be more supply, and there will be pressure on price, and there will be pressure on ability to grow in the market. Market share, I'm saying, your market will grow. You will correspondingly grow with your market share or marginally increase. You cannot grow your market share when market is constant, but you are capturing others players. That can only happen through inorganic acquisitions, or others are dying and you are surviving. Unless you know this, how will you know the revenue? Unless you know the revenue, how will you know the riskiness of the cash flows? And unless you know the riskiness of the cash flows, how will you determine the cost of capital? And therefore, how will you do the valuation? Now, Maitri just now said someone uses a jockey stick model. I'm more than happy they're using a jockey stick. Let them use a jockey stick, which sticks all that. I'm okay with that. I'll only ask you this question: what is your sales and marketing strategy? What is the amount of capital that you're bringing in? What is your cost of acquisition of the customers given this marketing strategy? They will give all these numbers because this is the famous new age jargons. If you say that this is the cost that you do it,
give me the past data. They don't have the past data. Then I said that if you're using this as a reference point, give me the comparison of any other competitors in similar kind of a business model where the cost of acquisition has been similar. For example, in retail business, they used to say cost of acquisition of a new customer is 2,000 rupees. The rationale, okay, we say that cost of acquisition of a new customer is 2,000. How does it come in? What they say is, when I particularly get a customer, I have to do an advertisement, second time, third time, my ability to convert when I do an advertisement is this many people will have eyeballs, this many people will actually purchase, but then there's a life cycle of that particular customer. I do that life cycle, and based on that life cycle and the total cost that I spend, I divide that, I get cost per customer. That's the logic of cost of acquisition. Cost of acquisition doesn't come in the air. Cost of acquisition, there's a science behind it. What is it? The number of times I have to invest in marketing spend year on year. Each marketing spend, what is the likely eyeballs I'm going to get it, and based on that likely conversion, what is the likelihood that that particular customers who converts survives and continues with me for some time? There's a life cycle for that. And given that the total revenue that I'm going to generate from those customers divided with the total marketing spend, then I get the cost of acquisition per customer. There's a reason behind it. So when someone says that I am a new company, I don't know I'm going to do it. If we don't have any of this, let's assume that we don't have any of this. That means we are all putting in a thin air and they're expecting us to value. How would you do the determination? Then you have to do a significant sensitivity. So what you do is, if this 2,000 goes to 4,000, value is this. If 2,000 goes to 500, is the value of this. Because the management itself is saying, I don't know. How can a valuer be so confident about a single price? And another important aspect in valuation that we tend to forget. What we tend to forget is, when we invest in money, certain business models are in the position of creating a brand. So the cash flows may not, today's projected cash flows may not reflect the brand value. But after 5 years, well, 6, 7 years, there is an inherent buildup of the brand, which itself has a value. So your income approach should look at, are we saying that this is a traditional run of the business, therefore no brand value? Or the projected terminal cash flows inherently as the brand value? Or any other intangible asset? Do we comment on that? And that's an important element in this entire aspect when you're doing the income approach. If you don't answer those questions, and once you know that question, you take a view. I have taken this. That's okay with this. That's because then you're very clear. Your value has this kind of a limitations. So it's perfectly fine. But if you don't even know, people don't know how to interpret this, whether this is already considered or not considered. And if it is considered, are these assumptions correct? And if it is not considered, are these assumptions correct? And of course, availability of capital. If the future growth projections are a function of the capital, one, we should know whether it is in a position to raise capital. Therefore, it's a complete riskiness. If the capital is not there, liquidity, the value is zero. It's a 0 and 1 game, right? Most of the startups face the same problem, right? 0 and 1, liquidity constraints. Then your cost of capital should have the liquidity risk. And you therefore also have to consider that in your discounting rates. And you are mentioning that this is the cash flow that they're trying to do. This is, if they do not get this particular capital, therefore my cost of capital from 3rd year or 4th year is different from the 1st, 2nd year. Because the capital that is required for the first 2 years, I already have it. But for the 3rd year onwards, I don't have it because I'm going to raise it. Any questions, sir?
So when we actually take it to the last year, which is the terminal value, you say that, okay, I would have reinvestment proceeds, so I can actually drop the cost of capital for that and have a separate terminal value as well.
Yeah. Right, sir. Easy hota na. Mera, see, please understand, the one which is growing today with uncertainty, are you saying that it will have the same riskiness after 5 years when the company is stable?
It will be more stable, correct. So my cost of capital will actually reduce.
So when someone is asking this question, I will answer this method. Why am I considering? So therefore, the numbers are considered not because of a thumb rule. The numbers are, see, for a terminal cash flows, the cost of capital will be varying. But once you get the terminal value, that value which you're discounting, that will be a normal 5-year discounting rate. I hope both are different. You understood, right? So I repeat this.
We are talking about using garden growth model, right? That
Garden growth rate. Yeah, suppose if you use a garden growth rate to arrive at a terminal value, numerator, right? In that, whatever is the cost of capital that you are considering, that will be at a reduced cost of capital rate because the riskiness of the cash flows have reduced according to the formula, whatever. Once you get an absolute terminal value, say 5 years, in the 5th year, the 5th year terminal value cash flow that you're discounting to today's term, that discounting rate will be same as the normal discounting rate that you have considered for the 5th year.
That is same. Okay. Only inside the garden growth model, the denominator is what we are discussing.
Yeah. The rationale is again the riskiness of the cash flows. I am looking at the riskiness of the cash flows. Why cash flow, if it is less risk after 5 years, that is the projected cash flow risk is lesser than how much I'm going to consider. Depending on that risk, suppose if projected cash flow also you're taking a higher risk, it will be a different rate. So my value, what I consider for the discounting is a function of what is the risk that I associate with those numerator cash flows.
But I think it will boost up the terminal value. No, Maithili?
Why?
Because
no, it will further reduce it, isn't it?
Okay.
Terminal value will come down.
I'll implement it.
No, I'll ask a different question. You have taken a cost of capital of 18%. Shilpa, what is the terminal growth rate you are considering? 5% typically? Is that what you consider?
I usually consider between 6 to 7%.
7%. Okay, you have taken I have not even discussed whether that's a real growth rate or nominal growth rate, but 7% is a real growth rate, not a nominal growth rate. And your 18% that you're considering is your real cost of capital. Am I right? Is a nominal cost of capital, right? Cost of equity. You said cost of equity is 18% right now? Agreed?
Yeah, you can consider that.
But so you are taking KE as 18%. It's a nominal cost of equity. It has inflation component already. Yes or no?
Yeah.
But in the 7%, is it a real growth rate or a nominal growth rate?
Very nominal.
No. I'm not using nominal as nominal meaning. I'm talking about GDP. Is it a nominal GDP or real GDP growth rate according to you?
It's real. We are expecting a stabilized growth rate.
I'm sorry, sir. Can you please explain what is nominal and what is real? It's very basic. I'm sorry, but.
Okay. We all understand real GDP growth rate is without inflation. What we see in the currently, whenever every country project gives the GDP growth rate, it's a real GDP growth rate of 6%. Today we have 6.8%, 7%, whatever RBI estimates. That doesn't have inflation part of it. Our nominal GDP growth rate today is around, last time was around 11% or 13%. It varies. 11% was last year. If my inflation is 4%, if my real GDP is 7%, my nominal GDP is 11%. So in other words, when I'm actually growing in absolute value terms at 11%, not at 7%. All the numerator cash flows, when you're taking price per unit, it already accounts for inflation. They're all nominal cash flows. They are not real cash flows. Therefore, when you're talking about your terminal value, the numerator, the growth rate, if it's a nominal growth rate, then the denominator will have a nominal cost of equity and nominal GDP growth rate. And if the numerator in the projected cash flows, if you want to shift it to real value, then it should be that terminal value should have a real GDP growth rate in the numerator, and denominator should have a real cost of capital and real GDP growth rate. Kindly look into this.
Because it is the capitalizing rate, it is astronomically, increasing the terminal value because it is a capitalization rate, the denominator.
We are calling it a capitalization rate because it's KE minus G. Otherwise, it is same thing. When you use the word one value, KE minus G, we call it a capitalization rate or a discounting rate. If we talk individually, it is cost of capital minus G or cost of equity minus G, depending on that capital structure. Kindly note, the K, if you are taking a nominal value, G also has to be a nominal value. So one of the ways to say is, my G is 7%, but it's a nominal growth rate for perpetuity because no country grows at 7% real growth rate for perpetuity. That's another way to look at it. That's why I asked you the question, is it nominal or real? So inadvertently, we already assume that this is nominal, this is GDP growth I consider. You should know the reason. We are considering that 7% when you say nominal GDP growth rate with an inflation of around 3% and 4%, a GDP growth rate of 3%, total becomes 7%. That's why we are saying that's right. But whenever, my question is different. Whenever you have an inflation of 3 or 4%, then would your lending, cost of lending, would it be 18%? Because if there are so many bankers here, the marginal cost of lending for the banks is a function of the inflation. And they add premium. Am I right, sir? Most of the bankers are here. How can you have your cost of lending be divide of the market inflations? So it's important for us, what number when we are taking it, the underlying premise of that. So when we take cost of equity minus, that's the reason why since we don't want to split these two things, and we are very uncomfortable splitting these two things, we use conveniently a discounting factor capitalization of some percentage times. Absolutely fine. So we need to know these numbers are not independent. We need to look at the underlying concept behind it so that we know the numerator is representing this, denominator is representing this, and therefore our values are correct. I know I have confused you enough, so my objective is satisfied. Okay. See, one of the reasons that don't mistake me, and I'm also learning along with you, all of you. We know and we apply, but we don't know, but we apply. So we have to constantly look at this, and once you start looking at these nitty-gritties, you would have so much power in your hands. Believe you me, you would have so much power in your hands that.
Yeah, Shital, can you unmute yourself?
You would have so much power in your hands. Please understand.
Sir, actually, one more small doubt. All our incomes are inflated incomes only, no? That way.
Correct.
Suppose when I say my revenue is growing by 5% or 10% every year, that is including inflation. So everything should be
nominal.
Like what you said, nominal rates only, no?
Yes. No, some people do a reduction. That's the reason why I asked this question. If you see my estimate of revenue, I asked the question, inflation hai kya karke? You remember the first page I wrote in the tab, my PPT? So we need to answer those questions. So I'm not saying that we want to segregate it. We don't need to do it because people do not have the ability to do it any which ways. Point is, once we know that we are taking a nominal revenues there in the numerator, then when we are coming at a terminal value, we should be conscious about this and we should take accordingly those numbers. And that is the reason why I said it is very important. And remember one thing, your cost of capital is a function of the market inflation and market GDP. It is not independent. Why do you think in US cost of capital is less? Because the inflation is less, the GDP growth rate is less. When GDP growth rate is high, there's a lot of demand for the capital, therefore cost of capital will go up. So anyways, with all your permission, unfortunately I'm unable to complete it. If you want, I can take another session. I have to now stop. It's 8:59. I have to rush. Ravi sir.
You owe us a two-stage growth model because you promised us in the beginning you will cover two-stage growth model.
Yeah, certainly. So if it's okay, other day I failed in completing the full session. So another time, if with your permission, sir. Today I have to leave 9 o'clock. Ravi sir.
Thank you, sir. Thank you so much. It was a pleasure meeting you. Yeah, Shilpa, you can continue.
I request Mr. Ravichandran to formally extend vote of thanks on behalf of BBA for today's speaker.
Yeah, this is the second innings, and again you have scored century, sir. Last round was in the statistics model, which we all remember.
All are bouncers only in the end.
Excellent one. You started, now I'm sure that so far we were, concentrating numerator, denominator 80% and numerator 20%. I think the 80-20 will change from now onwards, and the past financials, how long the past financials, how long this one, and also the key elements of revenue. That you explained it loosely in terms of quantity, marketing, and finance and other things. Really, it's an eye opener for us, sir. I mean, to be very frank, actually, a lot of things we used to do it mechanically. Now, we will again think a lot while analyzing the financials or projections or everything. Thank you so much. I mean, no words. We look for more and more this from you, sir. We'll continue to trouble you.
Thank you, sir. Appreciate it. Thank you so much. So I'll take your leave, Shilpa. And
Yeah, thank you so much, Mr. Ganesh. Mr. Krishna, can you please come on video?
Hello.
Hi.
Yeah, can you hear me?
Yeah. Okay. It's my pleasure to introduce Krishna. Are you visible on the video? I cannot see you.
That's what I'm trying to see. Do you see me on the video?
No, we are not able to see you. It's some a blurred picture.
Oh,
but you're not there.
I don't know.
Yeah, your video by default is not there. Do you want to leave the session and join back because the video is not working?
Yeah, just give me a second.
While Mr. Krishna will be working on his video, I have a question for the audience. Right now, I'm working on an assignment for conversion of CCPS. The assignment is about arriving at the conversion price for the CCPS, which were issued, say, some 3 years back. So now, how should this be treated? If it was CCD, I had the option of taking it as a debt. But now the circular reference, anyone from the audience, can you please guide me? Anyone? Ravi Shankar Garu, Maithili. Krishna, again your video is off. Mr. Krishna, can you hear me? Anyone from the audience? Please guide me on this circular reference issue. Unless and until I have a value, but it is also having the conversion price. How do I arrive it? What should be the denominator? Because I don't know how many preference shares I'll be issuing to him. Now only I'm arriving equity shares. Now only I'm arriving at the value. Problem. I'll take it separately with the experts. I think Krishna is having issue with the video.
Yes, ma'am.
Yeah. Meanwhile, while Mr. Krishna will join the session, I request all the participants to fill the feedback form. While this is not a CEP session, it's not a mandatory point to circulate the feedback. We would love to know, to hear from you. How was the topic? How was the speaker? What are your takeaways? And what is your suggestions to us to improve upon our sessions? I'll just call Mr. Krishna and understand his concerns. Among the audience, is there anyone who has done any SEBI AIF regulation compliance valuation report? Yeah, Mr. Krishna is back.
Hello, can you hear me?
Yeah, we can hear you.
No, I
Are you not able to hear us?
sorry about this. Just give me.
But we can hear you. Others are able to hear me, right?
Yes, ma'am.
Mr. Krishna? Actually, as long as we can hear you, you can proceed actually.
Sorry, my just
Now we cannot hear you, Mr. Krishna.
hello. Can you hear me? Hello.
Yes.
Loud and clear.
Okay, perfect. Sorry, I can't do the video because there's something wrong with my camera on the just today. I don't know what happened. So sorry about that. So good morning, everyone. Sorry about the delay. I am Krishna. I had the opportunity to meet a few of you when Shilpa invited me to one of your sessions. I think a few weeks back. I am joined in this with my colleague Prasad, whose camera hopefully is working. Prasad, if you're there, just say hi. Um, what I'm going to do is
Hi, everyone.
what I'm going to do is just take you through a couple of slides, maybe talk to you, and Prasad will take you through a demo of our private market tool. Right. So let me share this. Can somebody help me share my screen, please?
Yeah, you can share now. Mr. Krishna, you can also cover the pricing for the end during the end of the session.
Yeah. So what we do at Private Circle is multiple things. We have a research tool, we have a business development tool, and we also have a live marketplace. For the purpose of this presentation, we are focusing principally on our research product. And given the audience, which is principally valuers, I think what I understood from my session last time, I think there is a huge focus on getting the right business and transaction intelligence as far as Indian companies are concerned. I've heard many products being used, but my summary was that given the pricing, etc., and all, venture intelligence is a tool that has been used by a large proportion of this community, right? And I want to take this opportunity to introduce Private Circle, which today, apart from the chartered accountant community, we sell to today about 300 plus customers. Our customers include, especially if you look at business and transactions in the private markets, we have over 300 plus customers, institutional customers, venture capital, private equity, investment banks, so on and so forth. And pretty much the top customers across every one of them has replaced whatever product they were using. And these products range from venture intelligence to VCCH to traction to even capital IQ in some cases. I think the reason I put this slide is for all of you to know that we hold quality of information as the most important thing, and which is why you find leaders across our customers also using us because they trust the accuracy of our information. Now, before I hand it over to Prasad, we are going to be showing you two packages quickly. We have two packages. Actually, we will demo only one package. We have two packages. Over the past few months, we have been talking to a lot of, we've added a lot of valuers and auditors as our customers. We have two packages specifically for this community. One is compared to the venture intelligence package, which has been specially crafted for you guys. And then the second one is our base package, which if you have time permitting, Prasad can show you. So Prasad, do you want to, so once the demo is done, we could talk about the packaging as well. But just to give you a brief sense, we have monthly, quarterly, and annual packages. And we, especially for this community, we have made sure that we've given really good discounts because Shilpa insisted on giving more discounts than we usually do. So before I start with Prasad, just to give you a sense of our coverage between venture capital, venture intelligence, and us. The last I know, venture intelligence hired about 55,000 companies with financials. A large part of them were not updated, whereas in our platform, you'll find 175,000 and you can update within minutes. The number of deals covered were about 8,000. We have roughly about 250,000 deals that are covered, and the ones with multiples, especially for those who are looking at valuation certificate and so on and so forth. You probably have about 2,000 transactions with multiples and venture intelligence, but we have probably 50 times more coverage in our platform. So with that, I'm going to just stop the share and stop talking as well. And Prasad, can you demo the package that we had crafted for them, please?
Yeah, sure. Let me know my screen is visible.
Is it possible to make it slightly bigger?
Yeah, sure.
This I think is better.
All right. All of you can hear me, right? I hope screen is visible to everyone.
No. Presently, my image mirroring is happening.
Okay.
Now it's correct.
All right. So basically, the moment you log into a portal, right, we will redirect you to this screen that's called company master list, right? So you can see there are 31 lakh 30,631 entities which are registered as of today. Now, this list includes public, private, as well as LLPs. Okay, we are the only player in the market today who are processing LLP financials as well. Now certain basic filtering available on this screen, so which I'll quickly take you through. Suppose, say for example, you want to look at companies in certain sector, right? You can just come to industry column and choose the sector which you're looking at, say real estate, and click on submit and apply filter. You will get list of entities which belongs to real estate sector. Similarly, you can further refine down the list by choosing the subsector, right? You want to look at companies who are only in the co-working space, right? You can apply multiple filter like this, right? So similarly, we have incorporation date, state, ROC. If you want to look at state wise companies distribution, similarly ROC wise also you can apply the filter and get the list. In addition to this, we also provide advanced search functionality. Suppose, say for example, there are two use cases mainly. One is you likely already know the company name which you want to look at, so that you can directly come here and search like this, either based on the brand name, true name, or using the company's in as well, right? But the cases where you don't know the company but you want to screen companies based on certain keywords, subsector and all, right? You can just simply use double quotes over here. So let me take ibuprofen as a sample, right? You can type it in quotes like this, click on enter and apply filter. You will get all the companies, right, which matches this keyword. And at the same time, there is additional column also visible to you, right? So which will tell you why are you getting this result, right? If you click on this, right, you will get the list of different sources that we go through to get you this list of entities which matches ibuprofen keyword, right? So these are all the sources we go through.
Prasad, just pause a minute. I think this is very important for valuers, especially while getting comparables, because if you're valuing a company that is selling ibuprofen, uh, which is a drug, you would ideally want to compare it with other companies who make ibuprofen. You cannot both even in the pharmaceutical space, if you compare a company that is making ibuprofen with some other nutraceuticals or those kind of products, uh, uh, you are comparing two companies selling different products, and the margin profile may be different, the growth prospects of those two products might be different. So it is important that when you are uh, valuing and when you're comparing two companies, you need to compare them basis the products and services, not necessarily how the companies are classified. If you get even two, three companies which make the same products, then you know that you are getting the absolutely right comparables to compare with. That's just my 2 cents. Prasad, please continue.
Yeah, sure. So this is how you can use this screener. So as part of your package, basically you will get three screeners: company master list, list of all the entities which are registered with Ministry of Corporate Affairs; profiled companies, out of 3 million companies, how many we already have the data, financial information, valuation, etc. Then you'll also get deals information. I'll just quickly walk you through these screens as well. So in the profiled companies also you can run the similar search, right? But financials and deals information, or round of funding, all the informations are already available with us, right, for these set of entities. Suppose, if for example, if I do the same search here, right, you get the list of entities, right? Then similarly, once you get this list, right, if you want to take a look at those entities, you can just click on this company names, right? And you can understand the detailed information that what we provide. So let me take through one of the company profile. uh, One second. So let's take Kirana Car Technologies. Right? When you visit this company, so first you will get the overview, what this company does, right? And who are all the key investors who have invested in this company, and team is managed by who, right? And the quick facts you will get, when was this company incorporated, what's their auth capital, paid up capital, where are they located, who are the auditors who have audited their latest financials, and the latest financial snapshot, revenue, EBITDA, PAT. Similarly, you can see set of keywords over here. If you click on any of these keywords, it will take you back to the profiled company screener again with the pre-applied filter using these keywords, right? Then I'm going to income statement section. Here you will find two presentation basically. One is summary view, right, where you get the key numbers like revenue, EBITDA, PAT along with their percentages. And there is a small icon over here. If you click on this, you will also get the director's report. There's a searchable document in case you want to go through the notes to accounts, or or whatever has been disclosed as part of the director's report, that can be accessed over here, right? Then we also provide detailed statement, right? Detailed statement, you'll basically get the breakup of revenue, how much is from domestic, how much is from export, what's the split between revenue from ops and other income, right? Total income, and there are certain metrics we calculate, gross profit, operating profit, right? And also there are direct and indirect expenditure line items. You can find it over here, right? This is as filed by the company. We just fetch it and present it over here, right? And all this can be exported to Excel as well. And the formulas to calculate the metrics, everything has been given in each of these sections, right? And if you click on export, you can just click on basic Excel as well as the basic PDF to get it in Excel as well as the PDF format. Similarly, we present balance sheet and cash flow as well, summary as well as the detailed view, right? Suppose the companies who have filed consolidated as well as standalone, you will find detailed standalone tabs separately to analyze how the standalone entity is performing, right? Then there is download filing section. Now, if
Prasad,
you
can you just
want
pause
to,
here for a second?
yeah,
When you guys are modeling or you're looking at analyzing financials of any company, any other product, including venture intelligence, would probably give you, the revenue split, maybe the cost items, and will just tell you what the book PBT and the book PAT are. But in general, what they don't do is calculate the operating EBITDA, operating EBIT, or in case of balance sheet, calculating net working capital X cash, these kind of metrics, which are predominantly used in financial modeling, are not available in these products. So what tends to happen is, if you're a user, you need to download that data from Excel file, and then recalculate some of this in Excel files. What we have done is we have uh, already calculated these things for our users, so that they don't need to do that downstream Microsoft Excel work. Yeah, Prasad.
yeah. So you can access all the source document that they filed with Ministry of Corporate Affairs. We have categorized all those documents under each category, like annual returns, financial statements, share allotment, charge filings, AOA. Suppose you want to access incorporation documents, all of them are available over here. Suppose if you go to share allotment, companies, wherever they have filed valuation report also, like in this case, I can see over here, right? If you click on that, you'll also get, valuation report samples.
Just to add here, I'm sure all of you must be visiting the Ministry of Corporate Affairs many times. And therefore, I think all of you must know how painful it is, because many times in a day it does not work. We at Private Circle download roughly about 10 to 15,000 companies every month. That's about 300 to 500 companies almost on a daily basis. So we pretty much know that Ministry of Corporate Affairs server is down almost every day. The problem now, because of that, and if you're an individual user, you do not know when it is down, and therefore many of you must be facing problems like, I can't access it, and even if I access it, sometimes there are challan problems, and then there are download problems. And of course, Ministry of Corporate Affairs has this very small window of 3 hours. So if you have downloaded the first document, you have only 3 hours to download all the documents. Now, the problem with that is you paid the money and you have a very small window to download the document. So you can only download whatever you want to. But given that we are automated, we pretty much can download all the documents within minutes. In fact, we not only download the document, we process that and put it in a profile for you within minutes. So if the Ministry of Corporate Affairs server is on, then this whole profile will update within minutes for you. When I say minutes, it is roughly about 10 to 15 at best. And more importantly, let's say that Ministry of Corporate Affairs server is not working, then all you need to do is click update, and we will make sure that as soon as the server is up, we download it, we process it, and we send you a mail telling it is done, so that you don't really have to figure out when the server will basically be up, right? I think this is a feature that many people are really pained with, but something that we've solved very well. And if you actually look at so you can consider Private Circle as a Ministry of Corporate Affairs that updates within minutes, and you don't have to worry about when it is up and when it is down. Yeah, Prasad.
Yeah. So this was the
Yeah,
functionality
Prasad, can you
Krishna was mentioning.
slightly expedite and then show us
Yeah.
that multiple thing? All of
Yeah.
us
Yeah.
are
Yeah, that's the
curious
next
to
thing.
Sure. This is a section, right? You can see, fundraising history since inception, right? Suppose if you click on any of these transaction, right? So you will get this modal and click on get deal details, right? You will get more information about that particular transaction, including the transaction multiples, right? You can see post money, EV, pre money multiples over here, right? And
is
if you
revenue
scroll
multiple, no?
down,
It is showing.
this is revenue multiple, this is EBITDA multiple, this is PAT, and this is book value for post money, right? Similarly, we have it for EV
Can you
and
show for
pre
the
money.
next deal? Maybe
Yeah, this
Recently.
one.
yeah, 22, just show 20, 22 or a 23 one.
Yeah.
So if you see this, this is done in 23. So the trailing numbers are on FY23 basis. You can find post-money multiples, pre-money multiples. You can find book numbers as well, which essentially tell you both equity as well as enterprise value multiples. Now these, and if you go down, you'll be able to see who are the investors, how much did they invest, and what type of share was issued to these guys. More, there's a rather simple example where you're looking at Zepto, but Prasad, can you open Swiggy for a moment? So when we calculate valuations, we actually look at the conversion ratios of all the shares, and that becomes very important to make sure that that the valuation is right? So if you look at this, you would probably see go down. So you see the multiples on top, you see which investor put how much money and at what valuation, what is the stake, go down. And yeah, if you see here, the Series K preference share, that is actually at a conversion ratio of 1401. So, all of these things have been taken care of in calculating the pre-money and post-money valuation. And this is something that is trusted by pretty much the top private equity, investment banks, venture capital guys today. So you should not have any concerns regarding accuracy or the speed of this. Yeah, Prasad.
Yeah. So then there is another section, directors, right? Suppose you want to know who are all the directors who are sitting presently on the board of this entity, right? You can take a look at all the members over here. And there is also a small icon over here along with the LinkedIn information. If you click on this, you will get their individual, present as well as the past directorships.
Yeah, so this is
Okay.
the package that compares with a venture capital with the venture intelligence product. Prasad, would you like to just take them through the plans?
Sure.
Yeah, so like I was telling, we've heavily discounted our packages. You could basically try it on a monthly basis if you want. Now, our packages are all our pricing is usage based because, as you can imagine, we have to pay Ministry of Corporate Affairs for every company. So, Ministry of Corporate Affairs charges us on usage. So, our packages are also defined by limits in terms of what you can use. I think this screen, we will share it with Shilpa. She can share it with all of you guys. And you can go to our website or, talk to our customer support and we can get a trial for you. Typically, our trial is about 3 to 5 days. I think a 5-day trial for you to try the package out. There are certain limits there. Prasad can coordinate that for you between and Shilpa as well. And anybody who wants to try this product is more than welcome. We can pause here and probably take some questions if you guys have some questions now.
Yeah, while questions are being discussed, Prasad, you can also put on chat your contact details.
Yeah, sure.
Just to let you all know, this is a specially crafted package for those who are using venture intelligence. But for those of you who actually use a VCC Edge or you want a much better enterprise product, we have those packages as well. Prasad is happy to talk to you about that as per your requirement. Any question?
So the entire historical data is available as far as past financials is concerned, because the demo you're showing 3 years were visible on the screen.
No, that is because Zepto was a 3-year-old company. But
Okay.
typically we have data from 2014.
Okay. Thank you.
So if you see Swiggy, you see data from 2014.
Okay.
I request everyone to explore the software, make use of the trial period, and then if you really like it, go for it, because the charges are on user basis, monthly, annually. Everything is heavily discounted for our BVA members, and then it's high time we make use of it. Anyone has any doubts or shall we conclude the session? On behalf of Bangalore Valuers Association, thank you so much, Mr. Krishna, for showing us a demo of your product. Our members will surely take up the trial and then use the software, and then if they like it, they shall surely subscribe for it.
Sure.
I personally would like to say that I have subscribed for it, and I'm getting immensely benefited by getting more data when compared to others in the market at the same price. Thank you so much, Mr. Krishna. Thank you, Prasad. Thank you, everyone.
Thank you, everyone, for your time.
Thank
Have a
you.
good day.
Thank you.
Thank you.
Can I end the session now?
Yes.
Okay.